Guys, the market is crashing. S&P 500 dropped 4.8% yesterday, the largest drop since June of 2020. Nasdaq 100 dropped 5.4%, worst day since September of 2022. S&P 500 is now down 15% from the peak of early 2025. And of course, this is due to the market fearing about tariffs implication. And yesterday, JP Morgan raised its recession probability to 60% from 45% prior to April 2nd due to possibility of retaliatory tariff from other countries, weakening business sentiment in US, and supply chain disruptions. Couple hours prior to the recording of this video, China announced to impose 34% tariff on all US imports as a retaliation of the action of April 2nd. And plus, that's not it. Plus, there's a bunch of more restrictions which meant to inflict more pain on US, such as restricting the export of 7 types of rare earth mineral. Right, they're looking at the Ukraine deal. Seems like America wants rare earth, so China is restricting its export of rare earth to U.S. to make sure it hurts. And also they're scrutinizing over multiple American companies that are doing business in China on possible violations. China had a $992 billion in trade surplus in 2024, and the surplus has been rising sharply for the past 2 decades with no signs of slowing down. The uptrend is very obvious, it's very clear. And this indicates a strong and well-established manufacturing and a very strong export-driven company. China is increasingly seen as a challenge to the US economic dominance and the dollar's global reserve currency status. Trump is notably concerned and is viewing China's strength as a strategic threat. But China is a tough nut to crack for Trump. China consistently retaliated to the U.S. tariffs, especially since the start of Trump's second term, and the retaliation is super swift, which means that China is well prepared for the trade war, and they're following a pre-planned playbook. And so far, we're seeing no signs of slowing down or softness from China. So maybe the market crash we're seeing is that market is showing less interest in dollar-denominated asset because the fear of dollar losing its reserve status, and that fear is rising as the global tension is speeding this up. The US dollar futures index can be seen over here. It actually saw a 2.5% drop in a day. The USD holds reserve status largely because most global trades settle in US dollar. There's 3 superpowers in the world. We have US, we have European Union, we have China. European Union has been showing support for US dollar by conducting much of its trade in USD. China, on the other hand, is part of BRICS, which is an institution that's actively pushing for de-dollarization. So European Union's role is very important in maintaining the current US dollar dominance. So I don't think it's very wise to piss them off very much right now. And this is probably the most popular picture right now on the internet, with Donald Trump holding a chart on April 2nd showing reciprocal tariffs, each row showing a country. And this column shows how much the country is tariffing America. And this is how America is retaliating as a reciprocal. It seems this column makes America seem very generous. Because if you look at the first row, we have China. They're saying China is tariffing America 67%. And America is being such a generous country, is giving a reciprocal tariff of only half of it, 34%. So this 34% is adding onto the existing tariff on China. Right? Since the beginning of Trump's second term, just in 100 days, he added 20% tariff on China. And that 20% is on top of the existing tariff on China that was imposed before Trump's second term, right? So the actual tariff on China is a lot more than 34. This is additional tariff on China. So this chart lacks a column to show the current US tariff on every single country. It's kind of misleading. Trump says it's a discount. It's not a discount. It's the percentage that's added on top of the existing tariffs for every single country. The recent market chaos actually changed the interest rate expectation dramatically. This one is the CME Fed Watch tool derived from the Fed funds future to show you the probability of Fed funds rate in the future of increasing or decreasing, probability of the change of Fed funds rate in the future. Market is now anticipating 5 rate cuts by the year end. Right now, the rate is at 425 to 450 basis point, right? So right now they're anticipating the next one, the May meeting. I think it's going to be this. They're actually going to project a 25 basis point cut next meeting because this probability is shifting actually as I was watching it. And then they have the second cut in June, third cut in July, fourth cut in October, fifth cut in the December meeting. Prior to April 2nd, they were projecting 3 cuts. Now it's 5 cuts. The market believes that the Federal Reserve might be forced to cut rates to stabilize the economy from this risky fiscal movement. But I personally don't think Jerome Powell would be too happy or too willing to do that because Trump has tried to challenge the independence of the Federal Reserve multiple times already. So we have to watch and see how Jerome Powell is going to handle this. But most likely he will be handling this professionally. But Donald Trump did say something about firing Jerome Powell if he doesn't listen to him. And this morning, the March non-farm payroll data or the report was released today. And on the surface, it looked like a good report, right? We had the U.S. payroll surge by 227,000 in March. Largely exceeding the forecast of 140,000, even above the highest estimate on the Wall Street of 200,000. So it seems like there's an easing of the stagflation concern as strong job market is linked to strong economy. But unfortunately, the other aspect of the report is not good. The unemployment rate for March rose to 4.2% from the February 4.1%, and the expectation was only 4.1%. Thank you. Please like and subscribe.